If you are watching the ticker tape in New York right now, you are celebrating. You are seeing silver trade at 70.47. You are seeing green candles. You are seeing history being made. You think you are watching the cutting edge of the market, but you are wrong. You are looking at the past. If you want to see the future, if you want to know where the price of silver is actually going, you have to stop looking at New York. You have to look at Shanghai. Right now, as we speak, the Shanghai Gold Exchange is trading physical silver at a price that converts to roughly $75.20. That is nearly a $5 premium over the price in the United States. Do you understand what this means? It means we are living in a bifurcated world. In the West, the banks are fighting to keep the price down near $70. In the East, the industrial machine has already accepted that the price is $75. This gap, this $5 difference, is the most dangerous number in finance. It acts like a vacuum. It acts like a time machine. It pulls metal from the past, New York, and sends it to the future, Shanghai. And until those two prices meet, until the COMEX rises to match Shanghai, the vaults in the West will continue to bleed until they are empty. In this deep dive market alert, we are going to expose the Shanghai arbitrage. We are going to explain why the spot price you see on your phone is a lagging indicator. And we are going to show you why the breakout to $70 isn't the end of the squeeze. It is just the market trying to catch up to reality. The West is waking up, but the East is already at lunch and they are eating all the silver. Let's start with the math. In a perfectly efficient global market, an ounce of silver should cost the same in New York, London, and Shanghai. If there is a difference, traders exploit it. This is called arbitrage. If silver is $70 in New York and $75 in China, a trader buys the silver in New York, they put it on a plane, they fly it to Shanghai, they sell it for $75. They make a risk-free profit of $5. This activity, buying in the cheap market and selling in the expensive market, should eventually bring the prices together. Buying in New York raises the price. Selling in Shanghai lowers the price. Equilibrium is restored. But that isn't happening. The gap is getting wider. Why? Because the demand in China is so voracious, so insatiable, that even with all the silver flowing in, the price keeps rising. The arbitragiers cannot ship metal fast enough to cool down the Shanghai market. This tells us that the shortage is not a paper event. It is a physical event. The Chinese solar factories and battery plants we discussed in previous videos are bidding the price up because they need the metal now. They are setting the floor, and the COMEX in New York is being dragged kicking and screaming to match them. This leads to a critical realization for the investor. The COMEX spot price is broken. For 40 years, we believe that New York set the price. Why? Because New York traded the most volume, but New York trades paper volume, derivatives, futures, options. Shanghai trades physical volume, metal, bars, delivery. In a surplus market, paper sets the price. In a deficit market, physical sets the price. We are now in a deficit market. Therefore, Shanghai is the captain. Now, when you look at 70.47, do not think of it as the value of silver. Think of it as the discounted bid of a bankrupt casino. The COMEX is offering you silver at a discount to the rest of the world. And because it is a discount and the inventory is flying off the shelves, smart money is using the COMEX. The COMEX is effectively subsidizing the rest of the world, and they are running out of subsidies to give. This arbitrage creates a giant sucking sound. It creates a vacuum that drains Western vaults. We track the inventory levels at the LBMA and the COMEX. Every week, the numbers drop. Why? Because of the gap. Why would a miner in Mexico sell to a bank in New York for $70 when they can now ship concentrate to a smelter in China who pays $74? The flow of metal follows the money. The money is in the East. This means the Western exchanges are being starved of new supply. They are relying on legacy inventory, old bars sitting in vaults to satisfy delivery requests. But legacy inventory is finite. Once it is gone, the COMEX has a choice. Raise the price to match Shanghai to attract new metal or default. They are choosing option one. That is why we broke $70 today. It wasn't because of a chart pattern. It wasn't because of the Fed. It was because they had to raise the bid to stop the bleeding. They are trying to close the gap. But every time they raise the price, Shanghai raises it higher. It is a chase and the West is losing. Now, a word of caution. Just because Shanghai is higher does not mean New York goes up in a straight line. Arbitrage is messy. It takes time. There are shipping delays. There are capital controls. We might see days where the COMEX price drops sharply. The banks might try to smash paper to $68 to trigger stops. But remember the magnet. The magnet is $75. As long as that price exists in China, any drop in New York is just a bigger profit margin for the arbitrage traders. If silver drops to $68 in New York and stays at $75 in China, the profit spread becomes $7. That encourages more buying. in New York. So the Shanghai price acts as a buoyant force. It makes it very difficult for the banks to crash the price and keep it down. The physics of the market are working in your favor. So the price in China is higher, but who is paying it? Is it speculators? Is it the government? Or is it something bigger? In part 2, we are going to look at the industrial hoard. We are going to look at the massive stockpiles of silver accumulating in the free trade zones of Shanghai and Shenzhen. We are going to explain why Chinese solar manufacturers are buying silver just in case instead of just in time. And we are going to look at the risk of a supply shock hitting the US, Apple, and Tesla factories. If all the silver goes to China, what happens to American industry? The trade war is heating up, and silver is the ammunition. Stay tuned for part 2. We are going inside the Chinese vault. If you're just joining us, let's reset the map. In part 1, we established a critical fact. Silver is trading at $70.47 in New York, but it is trading near $75 in Shanghai. This gap is draining the West to feed the East. But why is China paying a premium? Why are they willing to pay $5 above the global price for every ounce they can get? Is it speculation? Is it a bubble? No, it is survival. China is the factory of the world. And the factory managers have realized something terrifying. They have realized that without silver, the factory stops. So they have stopped playing the game of efficiency. And they have started playing the game of hoarding. In part 2, we are going to look at the massive industrial hoard accumulating in the free trade zones of China. We are going to explain the shift from just-in-time to just-in-case inventory management. And we are going to expose the risk this poses to American companies like Apple and Tesla. While China vacuums up the supply, American factories are running on fumes, the trail. For 30 years, the global economy ran on a philosophy called just-in-time. The idea was simple. Inventory is waste. You don't want a warehouse full of silver sitting there doing nothing. It costs money. You want the silver to arrive at the factory dock exactly 1 hour before you need it. This made companies efficient. It made them profitable. But just-in-time only works when the supply chain is perfect. When supply chains break, just-in-time becomes too late. Chinese manufacturers learned this lesson during the pandemic. They learned it during the chip shortage. And now they are applying that lesson to silver. They are shifting to a new philosophy just in case. Instead of buying silver for next week, they are buying silver for next year. They are building massive internal stockpiles. If a solar panel maker needs 1 million ounces a month, they are holding 6 million ounces in reserve. Why? Because they know the price is going up. Buying at $75 today is cheaper than buying at $100 tomorrow. And more importantly, they are terrified of a stock out. If they run out of silver paste, the assembly line stops. The workers go home. The customers cancel orders. The cost of a shutdown is infinitely higher than the cost of the metal. So they pay the premium. They pay the $75. They view the extra $5 not as a cost, but as an insurance premium against running out. This creates a bottomless bid. As long as the factories are running, they will keep buying regardless of what the chart says. Where is this silver going? We check the Shanghai Gold Exchange inventory reports, and they show stocks rising but not exploding. So where is the rest? It is in the bonded warehouses. China has massive free trade zones in Shanghai, Shenzhen, and Hong Kong. These are special economic areas. Goods can enter these zones without officially entering the Chinese economy for tax purposes. They sit in limbo. We are seeing massive shipments of silver flying from London and Switzerland into these zones. Once the metal enters the zone, it goes dark. It disappears from the global visible inventory. It is not reported on the comics. It is not reported on the SGE. It is dark inventory. It sits there waiting for the solar factories to call for it, waiting for the battery plants to need it, or waiting for a strategic rainy day. This creates a statistical illusion. Western analysts look at the public data and say, oh, China doesn't have that much silver. They are wrong. They are only looking at the shop window. They aren't looking in the warehouse behind the store. The accumulation in these zones is estimated to be in the hundreds of millions of ounces. It is a black hole that swallows supply and never gives it back. We have talked about solar before, but we need to look at the numbers for this week. It is late December. China is rushing to meet its year-end installation targets. The demand for TOPCon solar panels is vertical. Chinese solar manufacturers are currently consuming silver at a rate that exceeds global mining production. Let me repeat that. One industry in one country is eating the equivalent of the entire planet's mine supply. This is why the price in Shanghai is $75. It is a bidding war between solar companies. Company A bids 72, company bids 73, company C bids 75. They are cannibalizing each other to secure the paste. This isn't speculation, this is industrial desperation. And because China bans the export of silver ore, They are forcing the miners to sell domestically, but it isn't enough, so they have to import. They are sucking the bars out of London. They are sucking the bars out of New York. They are draining the world to power their grid. Now let's look at the other side of the ocean, the United States. We have tech giants too. We have Apple, we have Tesla, we have General Electric. They also need silver, but they are competing with a Chinese juggernaut that is willing to pay more. If a refinery in Switzerland has 1,000 bars of silver and China offers $75 and New York offers $70, where do the bars go? They go to China. This leaves the US companies in a supply shock. They call their suppliers and ask for metal. The supplier says, sorry, it's allocated to Asia, or we can get it for you, but the premium is now $10. This is how inflation hits the US economy. It isn't just the Fed printing money, it is the physical goods fleeing the country to find a better price elsewhere. We are importing inflation because we are exporting our strategic assets. Apple might have billions of dollars in cash, but they cannot print silver. If the metal is in a bonded warehouse in Shanghai, it is not going into an iPhone in California. This creates a strategic vulnerability for US industry. We are reliant on a global market that is rapidly fragmenting into regional blocks. And right now, the Asian bloc has all the metal. So the metal is flowing east. The price gap is widening. But there is another layer to this story. Currency. Why is silver rising when the dollar is still relatively strong? Because silver is sniffing out a change in the global monetary order. The Chinese renminbi is becoming a resource-backed currency. The US dollar is a debt-backed currency. In part 3, we are going to look at the gold and silver standard emerging in the East. We are going to analyze why the Shanghai price is leading the world. It isn't just arbitrage. It is a loss of faith in Western pricing mechanisms. We are going to explain why the paper shorts in New York are powerless against a physical bid in Shanghai, funded by sovereign currency. The trade war is becoming a currency war, and silver is the scorecard. Stay tuned for part 3. We are looking at the death of the dollar standard. If you have been with us through part 1 and part 2, you understand the physical reality. You know that silver is flowing from New York to Shanghai because of a $5 price gap. You know that Chinese industry is hoarding metal just in case, while American industry is starving just in time. But this is not just a story about supply chains. It is a story about money. For 50 years, the United States dollar has been the reserve currency of the world. It allowed us to print paper and buy real things. We printed dollars and Saudi Arabia gave us oil. We printed dollars and China gave us toasters. But what happens when the world stops wanting the paper and starts keeping the things? What happens when China says, we will keep the silver? Thank you. In part 3, we are going to look at the currency war. We are going to explain why the Shanghai silver price is not just an industrial signal. It is a monetary declaration. We're going to analyze the shift from debt-backed assets to resource-backed assets. And we're going to show you why the paper shorts in New York are powerless to stop a rally that is being funded by the sovereign currency of a superpower. The trade war is over. The currency war has begun. And silver is the scorecard. To understand the Shanghai price, you have to understand how the East views wealth. In the West, we view wealth as digits, a stock portfolio, a bond yield, a bank balance. These are financial claims. They are promises to pay. In the East, specifically in the BRICS nations, they view wealth as resources, oil, wheat, gold, silver, things you can drop on your foot. They know that in a crisis, financial claims can be frozen. They can be sanctioned. They can be defaulted on. But a bar of silver cannot be hacked. It cannot be sanctioned. So China is moving toward a resource standard. They are not officially backing the one with gold yet, but they are shadow backing it by accumulating massive reserves of strategic commodities. They're making their economy bulletproof against a dollar collapse. When you see silver trading at $75 in Shanghai, that is the market saying we trust the metal more than we trust the dollar derivatives. It is a vote of no confidence in the Western financial system. They are willing to overpay to get the asset out of the dollar system and into the physical system. For a century, London set the price of silver. The London fix was the benchmark. A few bankers sat in a room and decided what silver was worth. The world accepted it. But today, the London fix is becoming irrelevant. Why? Because London doesn't have the metal. If you set the price at $70 but you have no silver to sell, your price is theoretical. It is a paper price. Shanghai has the metal, they have the factories, they have the smelters, they have the demand. So the Shanghai fix is becoming the real price. Miners in Peru and Mexico are starting to look east. They are asking, why should I sell based on the London price when Shanghai pays more? We are witnessing the due westernization of pricing power. The center of gravity is shifting because the East is net long and the West is net short. The shift in power guarantees a higher price. The owner always charges more than the borrower wants to pay. Now, let's go back to the banks in New York. They are short. They want the price down. Usually they smash the price by selling massive amounts of paper contracts. This creates artificial supply. The price drops. But in this new dual market reality, that strategy backfires. If New York banks smash the price to $65, but Shanghai stays at $75, the spread widens to $10. What does that do? It accelerates the drain. It makes American silver so cheap relative to Chinese silver that every single ounce leaves the country instantly. The banks effectively subsidize the export of America's strategic wealth. So the banks are trapped. If they smash the price, they lose the physical metal. If they let the price rise, they lose on their derivative bets. They are damned if they do, damned if they don't. This is why we are seeing the price drift higher. The banks have realized they cannot smash it anymore. They have to let the COMEX price rise to closing the gap with Shanghai. They have to let it go to $75. Otherwise, the COMEX defaults. The Shanghai put is under the market. Every time New York dips, Shanghai buys. It is the ultimate floor. There's one more layer to the currency war. Inflation. We often think inflation comes from the Fed printing money, but inflation also comes from currency debasement. As the BRICS nations trade more in local currencies, the demand for dollars drops. Those dollars come home to America. This causes domestic inflation. Silver is the canary in the coal mine for this process. It is rising because the petrodollar system is cracking. It is rising because energy is being repriced in gold and silver terms, not just dollar terms. When you buy silver at $70, you're hedging against the loss of the dollar's exorbitant privilege. You're betting that in the future, things will be priced in value, not in fiat. And silver is the most undervalued thing on earth. So, what is the target? We are at $70.47. Shanghai is at $75. The laws of physics say these two numbers must meet. Since Shanghai has the physical gravity, New York must move up. This makes $75 a magnetic target for the COMEX. It isn't speculation, it is equalization. Spread. Traders know this. They are buying the COMEX and waiting for the gap to close. This buying pressure is relentless. It ignores technical resistance. It ignores overbought signals. It is simply math resolving itself. So, the arbitrage is real. The currency war is escalating. The gap must close. How do you play this? Is it too late to buy at $70? Should you wait for a pullback? Or is $70 the new floor? In part 4, the final chapter of this market alert, I'm going to give you the investment strategy. I'm going to explain why dollar cost averaging is dangerous in a vertical market. I'm going to show you the ratio trade, how to use the gold-silver ratio to time your exit. And I am going to leave you with the final verdict on whether we are in a bubble or a correction to reality. The West is losing the silver war, but you don't have to lose. You can trade like the East. We are finalizing the battle plan. We have reached the final chapter of this market alert. We have traveled from the trading desks of New York to the bonded warehouses of Shanghai. We have exposed the $5 arbitrage gap that is draining the West. We have analyzed the industrial hoarding and the currency war. The picture is clear. The price of silver at $70.47 is a lie. It is a temporary discount offered by a broken paper market. The real price, the price paid by the people who actually use the metal, is already $75 in the East. And the laws of economics are absolute. Two prices for the same asset cannot exist forever. They must converge. And since the East has the metal, the West must rise. In this final breakdown, part 4, I'm going to give you the investment strategy. I'm going to explain why dollar cost averaging might fail you in a vertical market. I'm going to show you the ratio trade, the secret mechanism the wealthy use to lock in gains without ever going back to fiat currency. And I'm going to leave you with the final verdict on whether this is a bubble or the new normal. The gap is closing, the window is narrowing. Let's finish this. For years, financial advisors have told you to dollar cost average, buy a little bit every month, smooth out the volatility. In a bear market or a sideways market, this is great advice. But in a vertical squeeze, dollar cost averaging is a trap. Why? Because you are chasing the price up. You buy 1 ounce at $30, then one at $50, then one at $70. Your average cost keeps rising. You get fewer and fewer ounces for your money. When the market enters price discovery, like we are seeing now with the Shanghai gap, the strategy changes. The whales do not dollar cost average. They front load. They recognize the paradigm shift. They see that $70 is the new floor because of the arbitrage. So they allocate their capital before the gap closes. They buy the breakout. They don't wait for a pullback that might never come. If you are sitting on cash waiting for silver to go back to $50, you might be waiting for a train that has already left the station and burned the tracks behind it. The Shanghai floor suggests that any dip below $70 will be bought instantly by arbitrage bots. So the strategy for the aggressive investor is not to wait. It is to position. Secure your ounces. Get them in your possession and then sit on your hands. Now, the most important question, when do I sell? But selling for what? Dollars. Why would you trade a strategic asset for a currency that is being debased? The wealthy do not sell for cash. They swap. They trade one undervalued asset for another undervalued silver to buy 1 ounce of gold. Historically, this ratio reverts to the mean. In 1980, it hit 17 to 1. In 2011, it hit 30 to 1. Geologically, it comes out of the ground at 8-1. Here's your roadmap. Zone 1 ratio above 40. Silver is cheap relative to gold. You hold silver, you accumulate silver, you ride the volatility. Zone 2 ratio hits 30. This is your first signal. You might swap some of your silver for gold. You trade the volatile industrial metal for the stable monetary metal. You lock in the purchasing power. Zone 3 ratio hits 15. This is the all-out signal. History says this level rarely holds. At 15 to 1, you swap all your silver for gold. You have effectively tripled your gold stack for free just by playing the ratio. You never touched a dollar. You never paid capital gains tax. You just move from one metal to another. This is how dynastic wealth is built. Not by chasing fiat profits, but by accumulating ounces. Is $70 a bubble? The media will say yes. They will scream mania. But let's look at the inflation-adjusted math one last time. In 1980, silver hit $50. Adjusted for inflation, the $50 is worth roughly $170 today. So at $70, we are not even close to the all-time high in real terms. We are less than halfway there. Now consider the fundamentals. In 1980, we didn't have solar panels consuming 20% of supply. We didn't have 5 billion smartphones. We didn't have 48 VT electric vehicles. We didn't have a Chinese export ban. The fundamentals today are 10 times stronger than they were in 1980. Yet the price is lower. This tells me that this is not a bubble. This is a repricing event. The market is finally realizing that it cannot price a strategic energy metal like a paper collectible. It has to price it like oil. It has to price it like lithium. And since silver is rarer than both, the price has to go higher to ration demand. $70 is not the ceiling. It is the launch pad. Let's summarize the case for the week. Fact 1, New York is trading at 70 kudos from 40 hours. Fact 2, Shanghai is trading at 75 per dollars. Fact 3, this arbitrage gap forces physical metal to flow east, draining Western vaults. Fact 4, the only way to stop the drain is for New York to rise to $75. The path of least resistance is up. The banks are trapped. If they smash the price, they lose the metal. If they let it rise, they lose. The derivative bet. They have lost control. The Shanghai captain is steering the ship now, and the captain is heading for higher prices. So here's your plan. Ignore the volatility. Ignore the news anchors who don't understand arbitrage. Watch the spread. As long as Shanghai is higher than New York, you hold because the vacuum will pull you up. You survive the bear market. You survive the consolidation. Do not let them shake you out in the first inning of the bull market. The East is buying. The industry is buying. You should be holding. This concludes our investigation into the Shanghai arbitrage. The gap is real.